Every month when I get paid, I add to my investments. In this video, I'll walk you through the investing approach that I take, the accounts that I used, the investments that I made, and the reasons for doing so. If you'd like to stay updated on my investments and portfolio performance, make sure to hit subscribe. Now, let's get into it. The approach I take when it comes to investing is long-term. My plan is to stay invested for decades, essentially until either I stop working or feel like I've built enough wealth to partially or fully retire. Each month I contribute to 2 tax-advantaged accounts here in the UK. The first one is the Self-Invested Personal Pension, or SIP. This is my personal pension account. Contributions come directly from my business since I'm self-employed and co-own a limited company. Unlike a workplace pension, I have full control over what I invest in. But because it's a pension, I won't be able to access the money until I'm around 60, which is quite far away. The second account is a Stocks and Shares ISA. This allows me to invest without paying tax on any gains or income, and crucially, does not lock away my money, which makes it ideal for medium to long-term goals. Right now, my SIP is 100% invested in index funds. In my ISA, about 60% is in index funds and 40% in individual stocks. When it comes to picking individual stocks, I target high-quality, fast-growing businesses and aim to hold them for at least 3 years. If you're new to index funds, they're essentially baskets of stocks that mirror the performance of a particular part of the market. And this is done by tracking what's called the stock market index. One of the most well-known examples is the S&P 500, which tracks 500 large US companies. Index fund investing is often described as buying the market. Instead of trying to pick winners, you spread your risk across many companies. Historically, index funds have delivered strong long-term returns and have often outperformed actively managed funds, which are run by professionals who handpick stocks. Now, let's start with the investments I made in my Stocks and Shares ISA. This month, I added a brand new stock to my portfolio. Exciting, right? Now, this company had just reported slightly disappointing results, and the stock dropped about 2% on the day. Although that was on a tough day for markets overall, so all things considered, not too bad. Of course, I bought the stock before that dip. Classic timing. But I'm not fast because my holding period is measured in years, not days. Anyway, the stock I added was ADEN. ADEN is a global payments company based in the Netherlands. It helps large businesses accept online, in-app, and in-store payments from customers all around the world. The payments industry is still dominated by older, legacy providers whose platforms are often clunky and patched together from acquisitions and outdated tech. In contrast, ADEN built its system from scratch, giving it a modern, unified platform that handles the complexity of global commerce far more efficiently. What sets ADEN apart from competitors like Stripe, which focuses on startups and small businesses, is that ADEN targets huge global enterprises. We're talking companies like Meta, Microsoft, H&M, and Spotify, all ADEN customers. This strategy leads to bigger contracts, more opportunity to grow within those existing clients, and stronger retention. Once a company like Microsoft is using ADEN, they are unlikely to switch. It's a massive market, and ADEN is executing well. Net revenue grew from 534 million euros in 2019 to just under 2 billion euros in 2024. An average of 30% growth per year. While that pace won't continue forever, management expects revenue to keep growing in the low to high 20% range through 2026. In short, there's a massive payments pie out there, and I think ADEN is going to keep taking a bigger slice. It's a modern solution in a space full of outdated ones, and as payments become more complex, ADEN's single clean platform becomes even more valuable. This isn't a brand new name for our portfolios, actually. Jamie started investing in ADEN a couple of years ago, and it's now one of his largest holdings. Jamie being the other half of this channel. And while I've been trying to reduce the percentage of my portfolio that's in individual stocks, I still want those individual names to be top-tier businesses. ADEN fits the bill, so I was happy to invest £500 in this brand new position. I also topped up an existing holding, adding £200 to Alphabet, the parent company of Google and YouTube. This one was a pretty simple decision. Alphabet owns some of the best businesses in the world, has world-class technology, strong long-term growth potential, and is currently trading at a valuation that's cheaper than the US stock market average. Let's start with the obvious one, Google search. It still makes up the bulk of Alphabet's revenue, mainly through advertising. In 2023, search generated nearly $200 billion in revenue, growing 13%, even with all the noise about ChatGPT replacing it. In the most recent results, search grew just under 10%, beating analyst expectations. And while AI might affect how we search in the future, this shift will likely take years. Most of us still rely heavily on Google, even if we also use ChatGPT. And Google's already rolling out AI-generated overviews, which now reach 1.5 billion people. Then there's YouTube, which continues to grow. Ad revenue was up over 10% in Q1, premium subscribers hit 125 million, I'm one of them, and YouTube Shorts views grew by 20% year over year. Shorts are also becoming more monetizable. Plus, YouTube now sees 1 billion monthly podcast users. We actually have a podcast too, so maybe we should start putting it on YouTube? Let me know in the comments if we should. The third pillar is Google Cloud, which is the fastest growing part of Alphabet. Revenue grew over 28% last quarter. It powers infrastructure for AI tools, app hosting, and data storage. Now, it is behind Amazon and Microsoft in terms of market share, but it is closing the gap, especially with companies increasingly turning to Google's cloud for their AI needs. Google is also building its own chips and data centers to better control costs and performance, which is especially important for AI. And that's not all. Alphabet also owns Android, the world's most widely used mobile operating system, Google Workspace used by millions of businesses globally, and Waymo, its self-driving taxi service which grew to 250,000 paid rides per week. A real business generating real revenue. Now, Waymo is still far from profitable, but Alphabet has the scale, cash, and patience to build it out long term. And what about the valuation? At the time of recording, the S&P 500 trades at around 19 times expected 2026 earnings. Alphabet trades at just over 15 times. So in my view, you're getting better prospects at a cheaper price, which is why I added £200. Now, let's not get carried away with individual stocks. As usual, I also topped up my global pie with £300 this month. My global pie is made up of 2 global index funds on Trading 212. 92.5% of it is in the Spider MSCI All Country World ETF. The rest is in the iShares MSCI World Small Cap ETF. Together, they give me exposure to thousands of companies across the world, small, medium, and large. It's a passive approach that aims to match the market, not to beat it. Time and time again, investing in global index funds has proven to be an excellent hands-off way to build long-term wealth. I do like picking stocks, partly for the control and partly for the potential upside, but my core plan is to keep investing in global index funds every month for decades. Now, my global pie hasn't escaped the chaos in the markets this year. It's down over 10% in the past 3 months, which is not ideal. But it was still much more stable than individual stocks, or even popular index funds like the S&P 500 or the Nasdaq 100. That said, the current dip has me focusing a bit more on individual stocks. Fast-growing companies tend to fall further during market declines, creating potentially better opportunities. But, and this is a big but, I don't think we've seen the worst of it yet. At the time of recording, the US still has 145% tariffs on China, which is causing very real economic damage. The longer this continues, the worse it gets for the economy and the stock market. Now, I don't think these tariffs will last forever. Crashing the economy doesn't really help Trump, but I don't know how long they will last or how much worse things might get. So I'll continue adding to my global pie each month. If markets fall another 10 to 20%, I might shift more towards individual stocks, but for now, I'm doing both. Just a quick heads up, I've had my stocks and shares ISA with Trading 212 ever since I started investing. It's mainly because of their low fees, which helps me keep more of my returns. If you want to try it out, you can use code SNS bonus to get free fractional shares worth up to £100 when you sign up to Trading 212. It's an affiliate code, so we get a small commission that helps support the channel. Let's quickly run through what I did in my SIP, which is with Vanguard. I only invest in one fund there, the Vanguard FTSE Global All Cap Index Fund. It's a global index fund covering thousands of small, medium, and large companies around the world. It's slightly different from the Spider MSCI All Country World ETF that I use in my ISA. That ETF focuses more on medium and large companies, whereas the Vanguard Fund includes small companies too. This Vanguard Fund isn't available on Trading 212 because it's a mutual fund, and Trading 212 only offers ETFs. That's why I try to replicate the exposure in my global pie by adding the iShares MSCI World Small Cap ETF on top. I still prefer Trading 212 for my ISA because of the lower fees, but Vanguard works well for my pension. Okay, that's a wrap on my investments for this month. If you're curious, Jamie, the other half of this channel, shared his investments last week, so be sure to check that out too. And if you'd like to keep following along on our investing journeys, don't forget to hit subscribe. Thanks for watching, and I'll see you next time.